Welcome everyone to Bloomberg's Sustainable Business Panel on using data to measure impact. I'm excited to have a wonderful panel with us from across the market to discuss this trend. The market for ESG data is expected to grow by 20% next year, and the growth in data spending is mirrored by the growth in ESG asset flows. Just in Europe and in ESG ETF, we saw almost 200% growth. In the US, it was over 300%, reaching to over 131 billion as of August. And this is the tip of the iceberg. And it is precisely because of the strong momentum in ESG at the moment that investors need to be cautious in evaluating ESG data, which has become increasingly complex given the abundance of options. So please join me in welcoming Anna Snider. She is Lead Manager's Research and Investment Selection for the Chief Investment Office at Bank of America. And she also has been co-leading the Wealth Management, Sustainability and Impact Strategy since 2013. We also have Maya Chorengel. She is co-managing director at the RISE Fund, the largest private equity impact fund managed by TPG. She has 2 decades experience in private equity, venture capital, and impact investing globally. And finally, Nicolai Lundy is the Director of Partnerships and Market Outreach for SASB, where he helps investors, data and analytics firms, and other solution providers using SASB standards in their work. So, Maya and Anna, as investors on the listed side and more private equity side, how do you use data to help investors or to reinforce your investment decision process?
So I'll take that, I guess, first. This is Anna. So I think that, so I'm looking at managed funds. So for instance, I'd be looking at a fund like TPG or an ETF or a mutual fund or a separately managed account. So my team covers the entire investment universe across both public and private markets. And so we need a way to come up with, how we assess managers, not only on their how they run investments, like we do for all strategies, but in the case of strategies that hold themselves out as sustainable strategies, really how they marry the sustainability objective of the strategy with the investment objective. And the way we do that, basically, is to first have the manager be very clear about what their sustainability or impact objective is, and then what measures they're going to use to quantify that objective, right? What measures are they going to use to select the underlying portfolio companies or the underlying companies or issuers they're investing in, how they're going to manage those metrics, so how they're going to observe and track and monitor and manage those measures along the way, and finally how, of course, they're going to report them out. And they're going to demonstrate, what a client gets when they're frankly investing in a sustainable strategy. And so we normally ask the manager during our due diligence process to give us the set of data and information they're using. So we have become, I guess, well-versed in the different ways that different managers across different asset classes are using data, what data sources they're using, the mix of proprietary and third-party data sets that they're using. And I know we'll talk about the evolution of those data sets in a bit, but I think, suffice it to say that it has come a long way, sort of exponentially, if you move back 5 and then 3 and then 2 and even 1 years. We also use some internal metrics that we've developed, some exposure metrics. We don't use ratings or anything like that to look at different companies that are in a public equity, for instance, portfolio. But we do use third-party data to assess the different exposures over time for different strategies. So that is a way that we sort of check independently the way that a manager constructs their portfolio and just really validate what they're telling us, the process that they use.
Great. Maybe I can take it from that macro down to the micro. So within the RISE Fund, what we're doing specifically is investing in growth stage companies, private companies that have a meaningful and measurable positive impact on the environment and on society. And what we endeavor to do is to look at the companies that we're thinking about investing in and pull data from those companies, whether it's financial data or operating data or impact data. And we then link that data to academic research and evidence to inform our decision making. So what we'd like to do, for example, for an education company is to look at the projections of that company, think about how many students that company may be educating over time. And then we look for academic research and evidence that validates whether the kind of intervention being delivered by the company actually can deliver measurable good. Does the product result in increased learning outcomes? Does it effectively advance the ability of a child to do math in a shorter period of time? In financial services companies, does the financial product actually promote better spending and better saving habits, more responsible credit behavior, et cetera, et cetera. So we use impact data and evidence tied to academic research very discreetly to help us make a decision as to whether the company that we're investing in has the potential to deliver the positive impact that we hope to see. As an impact fund, it's very important that we set a very high bar for ourselves in terms of the outcomes that these companies might achieve, because we have a dual goal of generating both financial return as well as making a meaningful dent, if you will, on the impact outcomes that are outlined by the Sustainable Development Goals. So for us, data, evidence, and being very discreet about how to think about that with respect to the companies we're investing in is a very core part of our practice.
Thank you both. So it's very interesting indeed to hear from more the investor selection and how data is leveraged to appoint investors, monitors, and validate their strategy. On the other side, looking at the beauty of a private equity approach, which is access to information for the holdings and also leverage data, not only to invest, but also to measure outcome. Now, Nicolai, data is only as good as it is reported. So how does SASB, one of the main standard in the market, thinks about the framework that leads companies to report data that will be used by investors and their stakeholders?
Well, SASB's mission can probably be summed up in a very simple way by saying that we're focused on improving the availability and the comparability of ESG data that's useful for investment decision-making around financially material issues. So we're less focused, and we don't provide as much value add around thinking around impact and outcomes like the RISE Fund and what Maya's exploring, but where environmental and social issues can ultimately impact the financial performance of companies. And what is really important as you peel back that data question is that not all data is going to be created equal. And so when I said that it's availability and comparability of information, I also talked about decision useful information. So that actually occupies a lot of time at SASB when we design our standards. We don't end up using the data that companies report, but we can play a significant role in influencing what data is ultimately available to the marketplace. And so it's not just a question of what that data should be and what issues are likely to be financial material from one industry to another. That's basically the first order of operations that we have to think about as a standard setter. But then beyond that, we have to think about how can that data be prepared in a way that's of investor grade quality and ultimately can be designed in a way that can be subject to external assurance when it's chosen or when desired, increasing the trustworthiness and reliability of the information, or just subject to internal controls and board governance? How do we design metrics for disclosure that data can ultimately fit into existing reporting processes for robust, high quality data? And then, is it designed in a way that's actually useful for investor decision making? And so there are nuances to that question, because not all information is going to be equally useful for assessing corporate performance and value. Because if you think about if the information being reported has a very narrow distribution path, most every company is reporting around the same data, or you have data that provides a little bit of a broader distribution curve so that you might be able to identify leaders and laggards in a different way or in an easier way, then those are two very different profiles of information, and one might be better or more useful for investor decision making. And so we think a lot about the design of what data is ultimately going to be reported, and not only the what, but then is it investor grade? Can it ultimately lead to trust and reliability? And then how is that information organized to fit into existing decision-making processes? Everything from, use cases for fundamental analysis, use cases for index management and rules-based investing and quant-based investing, to use cases for proxy voting and corporate engagement and active ownership. So those are a lot of the questions that are often not always easily understood for shaping ESG data, but are just as important as figuring out what information should be, but then also how to design it to make it reliable and useful.
Thank you, Nicolai. And maybe could you comment as well briefly on the recent announcement of SASB and how we are seeing a necessary alignment across standards at the moment?
Sure. So for those who didn't see, just last week on Wednesday, the SASB and Integrated Reporting Organization, so the International Integrated Reporting Council, IRC, jointly announced an intent to merge, which will likely take place in summer 2021. And this really builds off what we've seen over the past several months and even couple years. Several years ago, you saw organizations coming together through the Corporate Reporting Dialogue to begin to create open dialogue and facilitation among standards and frameworks in the sustainability space. That has led to a couple projects and papers that have published, which led to the joint paper published between CDP, CDSB, IRC, GRI, and SASB just last summer to talk about a joint vision for the first time between all organizations around a coherent, comprehensive system for corporate reporting. And IRC and SASB are taking just that next step in this kind of ongoing evolution of coordination between these organizations, where SASB and IRC are both very focused on financial materiality and enterprise value creation and what information is useful for understanding corporate value, and taking a framework like integrated reporting and standards like SASB and finding ways that they can more easily fit together over time. So that is really something that we're just in the very early stages of figuring out, but the merger is expected to be completed in mid next year.
Thank you, because indeed, I think standards harmonization among all the frameworks available is key. 2020 has seen an unprecedented adoption of ESG data and launch of ESG strategy, but 2021 is expected to be even a bigger year for ESG, and there is an evolution and sophistication of ESG data across markets. So this will be a key trend to watch. And this leads me maybe for questions to Anna. So could you maybe comment on some of the challenges that we see in ESG data, but also as you are seeing possibly more comparing more investors in your selection strategy, if you're seeing a move to quant and alternative data to help fix possibly the data gap and the data gap quality we see in the market today?
Sure. I mean, I think it's something I could go on for a long time about, but yeah, I mean, I think there's a couple of significant hurdles. There's actually many significant hurdles. First, obviously, as Nicolai was saying, is the comparability, right, of data that is disclosed, and then there's data that's not disclosed that is important data for many investors to be able to make investment decisions. I think that big data and other, non-traditional sources outside of the corporate disclosure universe, which is, by the way, getting better and better because of investor action around that. Why we're part of the SASB and other organizations that are pushing for better disclosure. But I think comparability of data makes it really tough. I think behind the scenes, I mean, if you ever walk into an investment manager and they tell you that they're using raw environmental, social, and governance data, and they don't at least have a team that understands that data and how to compare it and actually use it in an investment process, I would nod your head politely and probably move on. But I think there's there's also sort of a top-down issue, right? Which is that if you have a multi-asset portfolio across public and private markets, equity and debt, long, short strategies, et cetera, you actually there's no common data set, right? That you can use to actually sort of say, well, what is actually the totality of my positive and negative environmental, social impacts on that my portfolio is creating over time, and it's this data is very structured today, both across public and private markets, as you heard sort of Maya talk about, in this sort of portfolio company or issue or type of construct, which does not allow for the investor to see this holistic view. So there's a huge amount of work to be done to get to sort of this comparability and the ability to roll up and roll data down. But certainly, data, as we cite in a number of white papers we put out, the ability to use data for much improved data over the last 8 years, 9 years since I've been doing this, and the ability to construct portfolios that are really strong investment portfolios. A lot of that has been made possible by lots of people working hard around both disclosure and seeking alternative sources of data. And I think, I just saw a company that was using the other day that was starting to use blockchain to look at impact, and I think that's that type of innovation you're seeing more and more of as data gets more sophisticated. So a little bit of around the world there in terms of both the hurdles and some of the great innovation that I'm seeing. But let me turn it over to the next panelist.
Yes, maybe Maya, could you maybe give us a view from the private equity world? How do you leverage data do you use, for instance, ESG data as a signal to help you confirm an investment idea? And also, possibly, do you use quant analysis to reinforce an investment decision?
Yeah, it's a good question. So within TPG, prior to even launching the Rise Fund in 2017, ESG had been an important part of our practice for almost a decade. And effectively, during a due diligence process, we would evaluate ESG factors for any company that was being invested in across all of the different fund platforms. And this was really for a few reasons. One was to assess risk. So there was a risk mitigation and a risk identification element to looking at environmental, social, and governance factors. Second was to identify opportunities where the companies that we were potentially going to invest in could be managed better by incorporating best practices around environmental and social. Within the private equity world, governance is always pretty key. So part of the mantra is always about best practices in governance, but E and the S also became very important with ESG. And so the signaling element there is around not just risk management, but an awareness of opportunities to run businesses better and to help them outperform their peers. I think what's important about the current environment, though, is that in the course of the last few years, with a lot of the focus on climate and the climate effects, and then in particular in 2020, because of the heightened focus on social and racial justice, not just in the United States, but in other parts of the world, ESG has continued to gain in emphasis and importance. And I think that it's a positive step. The challenges do remain that, as my colleagues on the panel have said, there are multiple frameworks. There's a lack of synthesis or standardization around how you measure, how you report, how we benchmark companies against each other. But I think as an industry, we're all working towards that end. So there's opportunity there as well.
Thank you, Maya. I guess we did speak about the data frameworks, how to leverage data to reinforce an investment decisions, to measure outcome. Can I ask maybe Anna first? So how can data be leveraged to effectively incentivize investment managers and hence companies reporting and standardization? So for instance, from equities to maybe even bondholders in the asset managers you review, how do you incentivize or leverage the ESG data to incentivize company data reporting from where you are in the value chain?
So this past year, we actually, so as you heard me say at the beginning, we, for managers that hold themselves out as doing sustainable or an impact strategy, we do a robust analysis of the sustainability objective and the measurement and monitoring, et cetera, that I talked about before. We actually decided that it was really important for all investment managers, whether or not they held themselves out as sustainable or impact or not, to be looking at what we believe are critical investment issues. And so we started doing, and we'll learn more as we go along, but we started doing an assessment of each investment manager that we look at, and to understand in their investment processes writ large, what kinds of investment data, or what types of, what kind of ESG data, or what kinds of data sources were they looking at, that the portfolio management teams had access to. That's generally the sort of first way that investment teams actually start looking at the data. They sort of have it at their fingertips, and they may not be using it in any investment decision. But we thought that it was really important that there are, material, environmental, social, and as Maya said, governance issues that any investor should be looking at when they're making an investment decision. And if you're not, we have a lot of questions as to why, you're running a company with, a portfolio with energy exposure, and you're not looking at environmental risk data, and you have no one on your team that has an inkling about how to actually, analyze that, right? That, to us, that's a red flag, whether or not you call yourself an ESG or sustainable fund. And that data is also, useful, for engagement purposes. So if you're a large asset manager, whether they're running an active or a passive shop, or strategy, you want to see that they're, using some of this data to form a holistic opinion, right? This is not about, separate, you don't run an investment strategy only on ESG data, and you don't we think you're not going to be able to run an investment strategy solely on, quote unquote, traditional financial data anymore, that those two things are emerging. And every investment manager should be considering this to a certain extent, especially those materials that we think are, those issues that we think are material investment risks. And I think there's the incentivization piece on that comes that ESG assessment, or the assessment of how people are looking at ESG issues across every asset manager, does have some influence as to whether actually we either put them on the platform, or they sort of maintain their standing on a recommended list, or we end up saying that we actually don't think that any longer we have conviction in them, and usher them off the platform. So there is a economic incentivization for the managers to start looking at this data, those who are not, and the process we put in place is meant to sort of put a stake in the ground and say that we think that this is really important, whether or not your label of your strategy is an ESG label. And we're seeing, certainly in equities, where you should be able to do that, but there's also a lot of interesting innovation happening in the fixed income markets, and not only innovation, but ways that managers are looking at, for instance, the way to look at municipals, and how to understand what sources or the uses of revenue are, how they're impacting communities on the positive side, and also looking at ESG risks as a way to identify additional information to look at credit default. So there's a lot of different ways that different types of asset classes and managers can do this. But what we instituted earlier in the year was really a set of what we hope is, they're not punitive. We hope that they are positive economic incentives to really look at these issues in a very deliberate way.
Thank you. Thank you, Anna. Maya, may I ask, and so possibly still on how to leverage data effectively, being on a private equity side, I believe you may be able to ensure reporting and progress by embedding ESG, maybe in the legal documentation and the relationship you develop with the target companies or the invested company you partner with. Could you give us a sense about how do you do that? And maybe also a sense to tackle a second part of the question, whether you have seen over your career enhanced performance by adding ESG data into your process.
Yeah, I think it's important to call out that the companies that we invest in don't see our request to report on impact or ESG data as a burden, but rather as something that enhances the overall business, because they embed some critical metrics into their overall dashboards. And they're indicators of the overall health and the overall value creation proposition of their company. So importantly, this isn't also collecting 200 additional metrics on a monthly basis beyond what they would do. It's really focusing on key drivers that create value on the impact side or on the ESG side that overall enhance the performance of the business. And we do see what we call a virtuous circle or a flywheel or collinearity between the impact side or the ESG side and the operating and financial performance side. So our companies see it as a benefit. We have a very structured way of looking at it as well, which helps, but that it's not a hodgepodge series of metrics, that it's very much customized to the business. And it's very focused and very much aligned with the drivers of value creation for the business. So being very thoughtful about this work is important. I would say too that a lot of our companies embrace it now because increasingly investors, whether they're this is pension funds or university endowments or sovereign wealth funds, who are becoming much more attuned to the importance of ESG factors, are starting to ask more questions about it. And I would also say, that consumers and the general retail public are very interested in this as well. You know, there were a lot of articles this weekend in the New York Times about the millennials and, you know, their value systems and the wealth transfer and the fact that they want the companies that they're associated with to reflect their values. So this is really just going to become more and more a part of the mainstream. And again, it's incumbent upon all of us as a group to make sure that we try to rationalize and standardize the data collection in a way that really expresses value creation. So we're not collecting data for data's sake, but we're trying to link it to where value creation exists.
Thank you, Maya. I think I turn to Nicolai and maybe explore the idea. So basically, we see laws being enacted. It started in France with, requiring asset managers to report the carbon footprint of their portfolios, which was the first really mainstreaming moment of ESG across markets, and leading to a much bigger investment in terms of engagement with companies from those asset managers. Do you have an example maybe of how do you leverage those engagement to incentivize, again, corporate reporting?
Can you are you saying engagement between the asset managers and the companies, or engagement? I'm trying to connect the dots between things like the policy developments.
Exactly.
Well, so the ecosystem around increased reporting and disclosure that's affecting the availability of data is really multifaceted, because you have operating in the capital markets, you have the investment managers, the asset owners, and the companies reporting the data engaged in ongoing conversations around, individual entities providing data. And then that is reaching a level that is obviously influencing policy, and it has been for some time, as you said, with Article 173 in France as one of the early examples of this. But it's only accelerating. You look not only in Europe, where you have things like the EU taxonomy focused on climate change right now, but other elements of environmental issues coming in 2021. Then you have SFDR specifically for the financial institutions that might be affected with companies in their portfolios and reporting on that data. And then it's not just in Europe. You see UK, quasi-Europe, outside the EU, just in the last 2 weeks has had a host of different either recommendations or new policy announcements that honestly, a lot of them have been lost because there were so many. Canada, New Zealand, Australia, Japan, all of them are accelerating either discussions or actual regulatory policy that is going to shape broader data disclosure beyond what you get from the interactions between the investment managers and portfolio companies. But it's not just the legal regulatory policy activity. You also have quasi-regulatory activity through the IFRS consultation. So this is a huge development potentially in the world of accounting, where you have the IFRS standards, the IFRS Foundation, exploring adding a new standards board specifically focused on sustainability. And that's a consultation program through the end of the year. You have the Securities Regulators Industry Association, IOSCO, that has been very publicly talking about where they see securities regulators globally increasing attentiveness to these issues, and IOSCO playing a coordinating role and information distribution role. And then we've already talked about the importance of standardization. And the one thing that I want to add to what I said about the group of 5 alignment efforts between standard setters and frameworks is that, so it's really helped clarify is that there's a difference between financial materiality and environmental and social materiality and impact, but that there needs to be interoperability. And that is really one of the key goals of the organizations focused on financial materiality, as SASB and IRC come closer together, also working very closely with CDSB, but then organizations focused on impact, really making sure that there's not just 2 parallel streams, but that there's interoperability so that it's easier for companies ultimately subject to all these demands for disclosure to actually report in a less burdensome way.
Thank you, Nicolai. And with that, thank you very much, everyone, for joining us today. I think 2021 will be an extraordinary year where regulators, policymakers are definitely tightening all the standard setting and requirements. Corporates are really waking up to this as ever faster than ever before, and looking at the best way to report, and obviously driven by the demand of investors and the pressure of investors. So this is all very exciting. And the idea is indeed to be able to leverage data to reinforce investment decisions, to measure outcome, and obviously leveraging different sorts of data, whether it's reported data, alternative data, and to serve all kind of strategies from quant to private equity to investor selections, bond or equity investing. Thank you very much, and see you very soon.